Hello, I'm Jared Nelson from the Investing Channel, and welcome to Pros and Cons, the show where we take you through the risks and opportunities behind the trending ideas in the market. 2020 was an extraordinary year in the stock market, and 2021 may well be no different. New milestones are being made in the market every other week. The latest saw the S&P 500 index hit a new record high of 4,019. If, amidst the gloomy lockdown a year ago, you made the prediction that the S&P would rise to 4,000 in 12 months, you'd be laughed out of the room. But nothing in financial markets is straightforward. Prices can spring into action at any time, and assets can reach levels beyond one's wildest imagination. Take Bitcoin. Who would have thought that Bitcoins would one day be worth more than $1 trillion? Now, S&P's powerful rally has brought its 12-month rolling return to the strongest level since 1937. That chart ought to tell you something, that S&P is in a strong bull market. The question is, are we at the start of the bull run or near the end? First, let's look at the bull's case. Many are forecasting that the S&P will continue to rise further this year. They base their reasoning on a few reasons. One, the continuing reflationary and accommodative policy from the Fed. Remembering the Fed is QEing at the rate of $120 billion a month, and the Fed chair has pledged no rate hikes until 2023. Two, a new multi-trillion fiscal stimulus program is being rolled out of the Biden administration, on top of the $1.9 trillion stimulus program passed just recently. This is the fourth stimulus program in a year. The multiplier effect of these programs are hugely positive. Three, a normalizing global economy later this year following the completion of mass vaccination programs in major economies, such as the US and UK, will further boost market sentiment. Based on all these factors, companies are expected to deliver earnings and dividends that are embedded in the buoyant stock prices. But not all portfolio managers are convinced that stock markets can continue to climb at this blistering rate. For one, the valuation starting point for investors now is very high. According to the Shiller valuation, U.S. stocks now are as expensive as they were back in the late 90s. When valuation levels are this high, future returns will be disappointing. Another concern is the soaring margin debt. Margin debt is borrowed money used to speculate in the stock market. As market rallies, leverage goes up. When speculators are leveraged up to their eyeballs, a tiny setback can cause the stock market to crash overnight. Look at Archegos Capital Management. The $10 billion family office was leveraged to the hilt and unable to meet margin calls when a few of its positions turned red and a fire sale took place. One of its holdings, Viacom, plunged 50% in a week. Margin debt in the U.S. now stands at more than $800 billion. Imagine if a few funds like Archegos were unable to meet margin calls due to a minor correction in the market. The cascading impact of forced selling would be catastrophic. The last bearish point is about the runaway bond yields. It is quite possible that, given how unpredictable markets are, Treasury yields may go up this year far more than anyone's guesses. When bond yields soar, it would put a lot of pressure on stocks, especially growth stocks. Moreover, the world economy is continuing to suffer from a long COVID. Nations are squabbling over vaccines, which is hampering the economic revival. Europe, for example, is on the cusp of a COVID third wave, despite vaccine rollouts. With so much uncertainty in the air, perhaps the only thing we can rely on is the chart, and S&P's chart is certainly bullish. Over the short term, we would not bet against the S&P registering more new all-time highs. History tells us that it does not pay to be short in the market when it is vaulting upwards. Don't forget that S&P's breakout at 4,000 is creating headlines that might attract new capital into the market. Fear of missing out is a powerful emotion. Trackstar IQ, our proprietary search tracking tool, shows us that the SPY ETF, which tracks the S&P 500, is the most researched by institutional investors in recent weeks. Nobody knows how long S&P's rally will last, but it is a rally that one should be able to participate in. However, after a year of tremendous rally, you cannot expect to bag the same outsized gains as before. Risk is much higher at current levels. Lastly, it might be prudent to sell some positions when prices are accelerating sharply upwards, say after 3 to 4 weeks of continuous new highs, due to higher probability of reversionary down moves. But we have not reached that point yet. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar.